What's up, guys? Today's video is going to be on Tesla. I mean, obviously you guys seen it blowing up like in the last couple of days, just like astronomically. And I've actually wanted to do this video for a while because, you know, I love Elon Musk. I like what the company stands for, and I think it was a great and good idea. But we're going to dive into a little bit of the fundamentals and see if the evaluation of, I think it was like well over what, $900 today. Just double checking. I mean, it has just been on a tear. Yeah, it's above 900. So first and foremost, if you're new to stocks or, you know, you're following this page just to get, you know, access to everything, the stock market is a futures market, right? So what, like the price you're paying today, that price is reflected on what you think or what the market thinks the value of the company is going to be in the future. How far in the future? I mean, that all depends, right? So you have a ratio that's called the PE ratio, which is like price to earnings. So that means like the price you're paying today versus like the earnings that the company gives you, you know, that gives you like a PE. And like theoretically, like a PE of 15 is like fair, and anything below a PE of 15 usually means the company's undervalued or going bankrupt. PEs of like 35 to like 40 have been very typical for companies that you're expecting high growth in the future. Companies like Amazon, companies like Facebook, companies like Alibaba, companies like Google. So that's kind of like a metric of like where it's at. So it brings us back to Tesla, and you know, let's talk about the negatives and positives. So I like went deep dive into it because I was really considering investing in it, but I'm a value investor, so I don't. And what value investor is just like a rip-off way, Buffett's way of just saying you like cheap stuff. So back to the PE thing. When you are a value investor, you want to pay what the company is worth today. You don't want to pay what you think or what the market thinks it might be worth tomorrow or in the future. You're like, nah, screw that, because we don't know. It's a high level of uncertainty, right? So you want the value that it is today. Much like real estate, you can determine the value of the asset today. Why? In like complex terms or whatever, I guess what you do is, if you know, a value investor would never buy a company that's young. You want to have at least 5, and I would say probably safe to say 10 years of a company being alive and generating revenue, so you could have a track record, right? So once it has a track record and you see the growth that the companies have, then you put in a formula and you say, okay, well, if they've, you know, if the first year they did business, they did 100,000, next year they did 200,000, then the next year they did 400, it's been doubling. Okay, then you say eventually this company is going to slow down, and like over the next 10 years, this is what I think it's going to be worth, right? You discount that. So you discount it back. And then also, most importantly, is the profits, right? The revenue. Revenue is one thing. You can have $1 trillion in revenue, but your profit's only $1. What can you really value that? You have to like build in a formula or build something that says, okay, I think that eventually you can make this much profit, you know. But coming back to layman's terms, just like when you look at a house, if a house is giving you $1,000 a month in rent, and I just do it times 10, which makes it $10,000, and I do 10% return rate, which is 100,000. Why do I leave the other 2 months out? I leave the 2 months out for occupancy rate, taxes, and insurance. It usually should be 9 because you want to have a capex, but we're just ballparking here, right? So theoretically, I say, okay, an asset gives you $1,000, it's going to be worth about 100,000. And I leave the capex in there as far as like over the next 10 years, you're going to raise the rate, raise the rent like $50, whatever. So that kind of covers it. But that should give you 10%. And in today's dollars, it should be worth 100,000. That's what I think. And like, so you should try to get it under 100, and that's called the margin of safety, right? So like a quick, you know, crash course on that. So it brings us to Tesla. So one of the bull markets, let's start with the bear. So the negative on Tesla is, at the end of the day, it's still a car company. They're in car manufacturing, the profits aren't really sky high. It's really tooth and nail, and you're grinding it out because, you know, you're paying so much for metal, you're paying so much for everything. You need like to make cars and to sell them and then to make a profit, right? It's not. It's like everything is time oriented. The principle of time value money never gets stronger than I think when it comes to cars, where it comes into research and development, putting the car on the lot, or like on the maintenance line or the manufacturing line, and getting it pushed out, getting it to the dealers and getting it sold. Everything depends on that. So one of the frustrations a lot of these companies and these guys have, and there's a lot of videos, there's former CEOs of like GM and chief executive officers on all kinds of Fox Business and NBC Money Market, like they're all over saying, no, short Tesla, it's horrible because And it's true, they don't have the production. They've had huge production issues in trying to meet their targets. They overestimate, like, oh, we're going to sell this many models, and they don't, and they fall short. So these are just the fundamental things that they're viewing it. Like, there's no way that this company is now the most valuable car company in the world, but yet it cannot even produce what GM and Ford does. Yet alone together what GM and Ford does is the amount of cars they output. They can't produce that many cars, so how the heck is this car company worth more? So that's the bearish, straight up and down, look at the facts, look at the book, kind of thing. But and many times we have seen investors that look into the future and say, no, you know what, we're going to stick, like for Amazon. Amazon hasn't been profitable for decades. I think last year or the year before, like in the very recent 2-3 years, they've been profitable. Is because investors have continued to pour in money and say, no, we believe in Prime, we believe in the value of this, and we don't care if it's losing money. We're going to keep buying and keep growing because we know eventually there's going to be a huge payday where it turns into a cash cow, which is generating you money, and you bought in at $100 or $30, and now you're worth well over $1,000. You're cashing out, and they start paying dividends, and then you're going to get $30 a year. You're going to make 100% return every year for the rest of your life. Like, it's a beautiful investment. Like, that's what everybody wants, and it's just, can Tesla hold out for that? Now, the bullish side, not what the bullish side is saying is you're looking at Tesla completely wrong. You're looking at Tesla as just a car company, and it's not. It is a software company. And when I read the bullish argument, I was like, okay, it kind of makes sense. And one of their biggest investors is a Sikh. He's Punjabi too, and it was just so funny watching him debate, and just like he was just crushing it. I was like, oh wow, like the fact after fact after fact that he dropped. I'll try to add it in the show, the caption below, the link to the video. But if you type in like bullish argument for Tesla, the video will pop up. And basically, he's trying to say is like, and it's true, Tesla has all the engineers, so there's a huge difference. And you could ask Google and all these other tech companies, there's a huge difference between software engineers and then like electrical and car engineers, right? Software engineers like coding and mapping and all that, because you need those guys to get autonomous driving. You need those guys to be able to send out updates and everything, and updates. So Tesla right now is one of the only companies, or it is the only company right now that's cleared to send automatic updates through the airwaves. Everybody else still has to do that hurdle. So not only do all these other car manufacturers have to start fighting for these coders and these software developers, which Tesla already has, and they have to be able to get the rights to be able to send automatic updates out in the open. So that's a huge advantage. Why? Because they're able to collect data at real time. That data is like machine learning and everything that it's having, so it's making it better and better to become autonomous. And I know there's a lot of people throwing horses in the autonomous race. There's Google, Uber, and Lyft, and just you name it. Everyone has a horse in that race, but Tesla has too, and I think they have a slight advantage because their cars are actually on the real road and collecting data every day, and they're being able to feed back and send updates wirelessly. So that's one advantage. Number 3 is Tesla also merged Solar City a while back. I think a lot of people forget, into the company. So they're not only selling you the solar system and the solar car, and they're becoming a complete package. But number 4 is they're already building the infrastructure, and it's kind of, a lot of my friends that have Teslas, they love them. Like a lot of people I talk to that have Tesla love them, and they do complain about, the charging stations when they go. It's kind of like, it's not like ideal like a gas station where you just go and you fill up in 5 minutes, you're out. It takes time, you got to wait. But already Tesla along, California and along other routes around the country are starting to build their stations out, and they're starting to build that grid, that infrastructure that are there for Tesla cars only, that other car manufacturers are behind on, right? So that's a huge, huge important thing. And this is like a bullish bearish thing because Tesla did do a deal where they did become the largest battery manufacturer, but it was a deal through Panasonic, right? So essentially, yeah, they are now the largest, battery producing company like in the world, but it's a really, like, you got to look more into the details of, like, I think Panasonic gains more than Tesla, but Tesla gets the recognition. But eventually, I think Tesla will corner the market on battery. So even if you're driving, whatever you're driving, you're going to have to buy, a Tesla battery to put it into your Porsche or to put it into your Ford or to put it into whatever. So these outputs plus the production that has came out recently in China has just been like stellar, has been just killing it, right? People are hungry for the cars, and you got a good, strong fan base. And the other company that we know that has a huge, strong fan base that people love is Apple. Anyone buys Apple, they're going to continue to buy, they're going to continue to push, and that company is just going to continue to propel up because you have a strong fan base, and Tesla has that. But one of the negatives, about Tesla is, the article that came out is they think it's not so much just the actual investors are there. They're thinking that it is the quants and it's the machines that are driving the price up. So this is why I say, like, don't listen to anyone that's on here talking about day trading. I can make millions. maybe you can, but the reality is people like us that just have regular jobs or trying to invest, we can't. We cannot compete with the quantum funds. Like what quantum trading is, there's literally computers built by quantum engineers that literally buy and sell stocks second per second per second per second. And they're flipping this for like a penny. They don't care if they'll buy Apple for $100 and $199.99, and they'll turn around and sell it for $200. They'll make a penny, and they'll come back and buy it back at $199.99, and they'll go back and sell it at $200. Like they're living on very, very thin margins. And if you think that you're going to be able to outbeat them, you just can't. You know, and one of the articles that came out today on Market Watch is they think that Tesla got super inflated, and they think it's a machine learning thing. And honestly, it kind of makes sense when a lot of these machine, like the way they're built or they're engineered is like they just follow like a pattern. So they see people buying, they're going to start buying, and it just kind of rips up, and you have this momentum trading. And then the government really hasn't intervened with this because they think that these quantum funds that have billions and billions and billions of dollars of buying and selling every day, it provides liquidity to the market, right? Because essentially, if it was just me and you buying and selling, we would judge the market a little bit more fairly. Be like, I'm not paying no $900 for Tesla right now. Like, I'll wait for it to get to 700. And then if you got a seller saying, I'll sell it for, 900 and no one buys, okay, well, now he has to sell it for $899. No one buys now, $895, and that's how the stock goes down. But there's always going to be a buyer. And there's always going to be, someone there to say, I'll take it, I'll take it, I'll take it. Then, of course, the price is going to go up. And I think that's one of the problems with ETFs right now. I think ETFs are not necessarily a Ponzi scheme, but they're not what they claim to be in the sense of like you always have a buyer that buys up and they're overpaying for assets. But that's a different thing. We're talking about Tesla now. So I think what happened and what the article is saying that they think they happened, and this is by Claudia Assess, and you can look it up on Market Watch today. But essentially they're saying is like, one of their biggest shorters of Tesla's coming back, and then he's saying that the computers took over. And basically, what they're saying is like once Tesla popped on the initial news of the China and them meeting production, and it popped like 10%. Then the next day the momentum gained, and they popped another 10, another 15, another 20, and today another 17. And they're saying it's no longer on future evaluations or valuation. It's just like a casino thing where it's just like these computers are just buying it. And eventually he's tricking other customers or other consumers and investors to buy it. That's his theory, and he's taking a short position. And basically what a short position is to kind of wrap this up. So this is like, I could go way more in depth and way more into the bearish bullish thing, but this is like a highlight video, and I just thought it was really fun to share because I'm a Tesla fanboy in a sense, though. But short position is like, let's say you have 100 shares of Coke. You bought them